My name is Gemma Yates. I am the Investor Engagement Lead here at ACCR, and I'll be hosting today's webinar. I would like to start by acknowledging the Gadigal people of the Eora Nation, who are the traditional custodians of the land that I'm dialing in from today. I'd like to pay my respects to elders, both past and present. So thank you to everyone for dialing into the BHP AGM webinar this morning. Some quick housekeeping before we get going. As I'm sure you're aware, we've allocated an hour for this session today. We have allowed some time at the end of the webinar for Q&A. So if questions do arise during the session, please just pop them into the box at the bottom of your screen, the Q&A box, and we will get to them at the end of the webinar. I also did want to flag that we are recording this session today. So as I'm sure you are also aware, ACCR has filed 2 advisory resolutions with BHP that will be put to the vote at the AGM. The first relates to lobbying, and we are seeking that the company advocate positively for Paris-aligned climate policy. The second requests that BHP incorporate a climate sensitivity analysis, including 1.5 degrees scenario, into their financial statements. So we will start today with Harriet Cater, ACCR's Australian Climate Lead. She will discuss our recent engagement with the company. We're also very lucky to have Sue Harding join us today. Sue is an international expert in company reporting and governance with the Climate Accounting and Audit Project, and she has over 30 years experience in the area. So it'd be great to hear what Sue has to say today as well. Alex and Harriet will then take you through each of the resolutions in more detail. We expect a lot of people will be watching this webinar or watching the recording of this webinar today. So if you do have questions after watching the recording, please just reach out to myself or my colleague Martin Norman, and we will endeavour to get back to you straight away with questions. We're also available for a chat at any point if you would like to book one in just to go through the resolutions in more detail. So without further ado, let's get going, and we'll kick off with Harriet.
Thank you so much, Gemma, and everybody who has joined us today, and also expressing my thanks to Sue for joining us as our guest speaker. It is particularly good to see a number of you here today because we learnt on Tuesday that BHP has scheduled an investor briefing on these resolutions at this exact same time. We note that this is the second time that this has happened with BHP. It happened with our resolutions in 2020 as well. We're pleased we're able to record the session to circulate this so that those who've missed out this morning will still be able to catch up on the content. And I strongly encourage people to get in touch directly if you have further questions. We thought it might help to just start with a bit of framing on our engagement with BHP over the years and this year as well. So we've had a long-held interest in BHP. We filed our first shareholder resolution with the company in 2017. Our focus mostly has been on the company's lobbying footprint and the conduct of its industry associations. In 2021, for the first time, the BHP board endorsed one of our shareholder proposals, which sought that the company enhance its review of industry associations to identify areas of advocacy that are inconsistent with the Paris Agreement, and to escalate and suspend the membership if that advocacy is identified. This year, we have had a number of discussions with the company, covering a number of different areas of kind of concern and inquiry. One has been on the seeking that the company strengthen its 2030 Scope 1 and 2 emissions reduction target, or at least to amend that target following the BHP Petroleum demerger to reflect the shift in the baseline. We note that the company still has not updated that target. We have continued our discussion with the company on its approach to lobbying and its industry association membership. Some investors may be aware that the company suspended its membership of the Queensland Resources Council due to the QRC's conduct in the Queensland state election in 2020. We have learnt this year that the definition of suspension from BHP's view has been a continuation of the payment of membership fees, as well as participation in some meetings, and there is still board representation there at the QRC. So it's just important for us to all, when companies are using the language suspension with regard to industry associations, it's a great lesson to actually get into the specifics of what that actually means. Another area of focus with BHP has been the company's views on steel decarbonisation, which is closely related to its approach to metallurgical coal mine expansions. You've probably seen some pretty staggering dates being thrown around of mine licence extensions being pursued by the BMA joint venture, including a 90-year extension for the Blackwater South mine. Another area of focus with the company has been on its approach to methane management for its operating coal mines as well, considering just how critical it is to constrain methane emissions at this juncture. And of course, we've also been talking with the company on how it's been reflecting climate change in its financial statements and audit. So those series of discussions kind of led us to landing on the 2 resolutions that we filed with BHP this year. We viewed both of these asks as quite reasonable and supportable. We actually expected that the board may, like it did in 2021, may endorse both of the proposals. It's since transpired, as per the notice of meeting, that that's not the case, and that the board has recommended against both of the resolutions. BHP has engaged with us and sought that we withdraw the resolution on the accounts and audit resolution. It named a series of concerns it had with that proposal. We systematically addressed those concerns, and Alex will talk to this in more detail later on. However, we saw that BHP has reiterated those concerns in the notice of meeting. And for both of the shareholder resolutions, our view is that the reasonings that BHP has articulated in the notice of meeting is a bit inconsistent and sometimes a bit contradictory, and we will talk that through today. So without further ado, I think it is Sue's turn to get into the nitty-gritty of why it is so important to reflect climate change in financial statements and in audit.
Okay, thanks very much, Harriet, for that sort of introduction and background. I guess a lot of what I am going to cover is a bit further background in terms of the importance of accounting and audit and work that we've been involved in at the Climate Accounting and Audit project over the last several years, working up to sort of where we are now in sort of company analyses and providing support to investors on various initiatives. Can I have the next slide, please? So first, CAP, the Climate Accounting Audit Project, is an informal team of accounting and finance experts. All of us have worked extensively in the investor community. I'm sort of the accountant on board and former auditor, so bring this sort of technical expertise to it. And our objective is really to address this so-called anomaly that financial statements do appear to ignore climate risks. As a result, they may encourage investment that's uneconomic, leading to further stranded assets, assets that will become stranded in a sustainable world. We encourage compliance with both the accounting and the audit requirements. And also we're seeking to address additional investor requests, and this will be quite important as I go through some of the methodology and steps that have been taken already. In terms of why accounting for climate matters, it's sort of why accounting matters actually, in terms of accounting producing the measures of profits and losses, net assets, which are the basis for financial modeling and various decisions. Financials can drive investment decisions, both by the company, approval of profitable projects versus rejecting unprofitable projects, decisions by investors, both across their stewardship activities and in assessing their own climate-related commitments. And financials, in part at least, drive financial policy outcomes, so remuneration decisions, policy and decisions, dividends payment can be affected, borrowing levels and limits and compliance and those sorts of things. So the financials are pretty core to supporting investment activities. our focus on financial statement is also, and this is really pretty key in terms of kind of where we're coming from. It's different from, but very complementary to other actions being taken on ESG reporting, including disclosure on climate that's outside of the financial statements. And consistency across reporting is absolutely important in terms of avoiding inconsistencies that can raise questions of whether there's a misstatement in narrative reporting or financial reporting, issues of greenwashing that inconsistencies can give rise to. So it is quite important that this be made right. So in terms of current requirements, there's a very strong foundation for climate being addressed in existing accounting and auditing standards. I've given a few references there pertinent to the conversation today. The Australian Accounting Standard Board and the Auditing and Assurance Standard Board jointly issued a bulletin back in 2019 stating as much and giving some guidance on what it is that is required in the standards. This was followed by the International Accounting Standard Setter for Accounting and Audit, the latter two listed on the slide, in their own practice bulletins and guidance notes. What the IASB has said about accounting is, and the others did as well, what's really important is that the existing requirements be adhered to. And in IFRS sense, there's a load of various topics that might be pertinent to consideration of climate. I've listed the standards on the slide. And we need to really bear in mind both accounting adjustments that may arise from the consideration of climates, as well as disclosure that may be necessary under the current requirements. And those accounting adjustments may arise in terms of, for example, consideration of impairment of property, plant, and equipment and intangibles like goodwill, changes in asset lives. Usually we're thinking about reductions in those asset lives as assets need to be retired earlier, asset retirement obligations that may be associated with those assets. They may be brought forward, obligations may be higher than they are currently reflected if they're brought forward, and less discounting is taken into account. And various other sort of things listed in the slide and under the standards in terms of the adjustments. Many of these do require forward-looking judgments, some of which are very interconnected. So impairment of assets, you need to be considering the future cash flows generated by those assets over their remaining lives. BHP has disclosed that remaining lives range from 2 to 104 years. So that's quite a range. That doesn't give us a lot of sense as to what's going on. But as you can see from that, estimation and best estimates over very extended periods of time are required to be made under today's accounting requirements. So in terms of some of the disclosure principles, because a lot of what we're involved in is sort of looking at accounts and indeed audit reports. And if it's not disclosed, we can't tell what's going on, as would be the similar position that investors may find themselves in. There are quite a number of disclosure requirements in IFRS standards on which Australian standards are very strongly based, nearly identical as I understand it. There are requirements in other topical IFRS standards, such as the standards I listed on the prior slides, but there are also overarching requirements in IAS 1 that require information to be sufficient to enable understanding of particular transactions, events, conditions, for example, information on judgments that have the most significant effect on the amounts recognized in the financials, and further requirements whereby a company needs to look at sources of estimation, uncertainty, and provide additional disclosure if there's a significant risk of change in the next financial year. So, and there are also requirements for disclosure of material information. And this really takes into account whether omitting, misstating, or obscuring information could reasonably be expected to influence the decision of the general purpose user, so the investors in the company. And materiality depends on both the nature and magnitude of information, or both. And I guess what I would say on climate is it's a material risk and a topic for consideration in accounting and disclosure, whether or not, therefore, whether or not it has a quantitatively material adjustment impact on the financials. And this is all very strongly backed up by the guidance that the standard setters themselves have provided. There's also, as you might imagine, strong investor interest in climate from the primary users, the investors. Climate risk is viewed as a business risk and a financial risk for many companies. What opportunity for some? That's another side of this. Business risk and financial risk can mean investment risk to those investors that hold shares or may wish to not hold shares. Those decisions they need to make. I suppose there's also opportunity in that, so investment opportunity as well. But business risk, financial risk may also represent financial statement risk, i.e. the risk of material misstatement of financial statements. And so now I'll just touch on some of the things that have been done over the last few years. There's been an open letter from PRI and other investor networks, including, and I've got the acronyms on the next page. Most of you will know them anyway, but IIGCC, IGCC, AIGCC, etc. So welcoming IFRS guidance that spelled out climate being already required to be addressed, asking that auditors ensure that that guidance is applied and regulators enforce it, and making an additional request that financial statement assumptions be Paris aligned or a scenario analysis be applied to provide information had those assumptions been applied. IIGCC has been involved in various campaigns, writing to companies and audit committee chairs over several years. And we ourselves have been involved in some company analysis over the past few years. We've performed some of that. Carbon Tracker Initiative has performed very much more of that. Last year, they issued their first report called Flying Blind, the Glaring Absence of Climate Risk in Financial Reporting. And that report and the analysis that we had published showed that there was very little evidence that climate risk was being addressed in financial statements and audits. So we've sort of taken this further into a formalization of company analysis through or on behalf of the Climate Action 100 Plus, in the context of their net zero company benchmark. So this involves the various networks that I've spoken of previously, 700 investors, 68 trillion in assets under management. And all companies that I'm going to be talking about involved in this work, analyzing companies, are companies that are on the focus list of the CA 100 Plus. That's 166 companies that are essentially responsible for over 80% of corporate industrial greenhouse gas emissions. And in March of this year, the benchmark was extended to include a specific climate accounting and audit assessment using a published methodology that I'll touch on the next slide. So here are the various indicators, metrics that are scored under that assessment. The first category in financial statements and the second category of the audit report very much are based upon the requirements already existent in the international and or in this case Australian corresponding requirements for those financial statements in the audit report. Looking for a demonstration of how climate has been considered, information on assumptions and estimates, consistency, the point I made earlier, and then we do the same essentially for the audit report. And then there is this further alignment with net zero emissions by 2050 or sooner, and looking for either the use of aligned policy or assumptions and estimates or a disclosure of a sensitivity to that analysis. And that's where sort of the rest of the discussion will be going. So this is just a little bit of a snapshot in terms of the first tranche of assessments under the CA 100 Plus methodology. So you can see on this slide, out of 165 company reports that were analyzed, there were only 6 companies that were scored as having met the metric requirements. BHP was one of those companies that did meet one of the metric requirements, and that was for the incorporation of climate in the financial statements. So the consideration, that initial baseline consideration, but they were felt to not provide the additional disclosure of assumptions, have issues with consistency of reporting that you can also see. Also, something to note on this, the initial assessment, not one company of the 165 met criteria of the methodology for alignment with net zero by 2050 or the 1.5 degree scenario. So this slide shows that there has been some incremental advancement. We're now sort of up from overall assessments of only 6 companies. It's now 8 companies of 134, and that the most recently issued benchmark information, so 6% success in terms of at least partially meeting. And what I would really point to would be that far right where I've circled the 3 companies that have actually now provided that sort of scenario analysis with aligned assumptions and impact on their company financials. 2 would have significant write-offs of assets. 1 found that even under aligned assumptions, they had headroom on their impairments and they would not have had write-offs. But it's just demonstrating that there is forward movement. More companies are providing better information on climate, and some are even going as being able to go as far as providing the scenario analysis. So this is my last slide. Just in terms of the sort of where we are now on BHP, Carbon Tracker's analysis of the June 2022 reporting has not yet been published. Progress has been noted by the company, but we wouldn't be expecting any change to the binary metric scores under the method of the CA100 plus methodology. Financial statements, there's good information on policies and approaches, but not so much information on actual assumptions and estimates that have been made. There are issues. The company acknowledges with consistency in terms of not showing in the financials yet the impact of scope 3 targets that they have set. And then just furthermore on the net zero alignment, that sort of bottom category, and what we'll probably talk about next. Aligned assumptions have not been used, and I don't think they would be expected because the company does not believe a 1.5 scenario is the most likely future outcome. So their best estimates would not be consistent with that. However, just 2 points on that. I think they have attempted to make some disclosure of a scenario analysis, but the disclosure of those alternative aligned assumptions is very much needed to understand the results, so they would not get credit under the benchmark for that. And additionally, I would make a note just on the accounting standards require impairment analyses, which is this topic is sort of focused upon, or at least the primary area where it's focused upon. And there are requirements for grouping of assets. The accounting requirements do not allow overall portfolio approaches and offsetting of gains on some against losses on others. So, as a result, some assets may need to be impaired, even if there is an expectation of net positive impact on a company. And that may well be where BHP is. I'll turn back to the next speaker. Thank you.
Thank you very much, Sue. That was very thorough and informative. My name is Alex Hillman. I'm a lead analyst with ACCR, and we'll talk to the resolution that we've raised against BHP on the accounting and audits. So here's the wording of the resolution. The key bits about this is we're not asking for what some have called Paris-aligned accounts. We're not asking for BHP to change their central view that they reflect in their financial statements. We're just asking for a sensitivity aligned with 1.5 degrees. Including all the quantitative estimates and judgments for all scenarios used, and to cover all commodities. So that covering all commodities talks to Sue's last point around how individual assets may be treated differently and an aggregate result isn't sufficient. For a bit of extra context, we'll let everyone know that we also raised a very similar resolution against Origin Energy. And the only difference there is that highlighted, is that because Origin apportioned their segments and cash generating units a bit differently, we had a slightly different request on how the breadth of the resolution should be covered. So when we look at how Origin and BHP have responded, briefly looking at Origin's progress. So when we first spoke to Origin about including climate change in their financial statements, they're actually just a bit bemused about why they would need to cover climate change in financial statements when it's already covered elsewhere. About 3 weeks after that initial conversation, they managed to do a decent job of articulating in a semi-quantified manner what climate change would do, or what a 1.5 degree scenario would do to their assets. And they said half their one of their segments would be positively impacted and therefore have zero impairments, and the other, integrated gas, it would have a negative impact. They disclosed the input assumptions, and they said that it would be impaired in that sensitivity, but they didn't quantify the scale of that impairment. They since announced that they plan to improve their disclosures in FY23, with the exception of exploration assets, but they have, subsequent to that as well, they have announced that they're exiting their main exploration asset and plan to exit the remaining exploration assets. So exploration isn't material to their portfolio anymore. And so effectively they've said that they will comply with the resolution, and as such we have withdrawn that resolution. So it's interesting to see that Origin from literally complete silence in the financial statements within the space of a couple of months, they've got to the position where they're willing to comply with a 1.5 degree sensitivity in their financial statements. On the other hand, BHP, for at least a couple of years, at least in 2021 and 2022, concluded that they assessed a 1.5 degree sensitivity in the notes to their financial statements. They said that it would have a positive impact on most, if not all, of their commodities, with the exception of energy coal. So energy coal, they impaired by $1 billion, not as a sensitivity, but an actual impairment of $1 billion. And the net asset value of that, or the asset value of that, is now less than zero. So they've said that beyond that actual impairment in 2021, there will be no impairments across their portfolio in either of those years. What we do know in terms of what they've said about their scenarios is, even though they haven't disclosed the commodity pricing assumptions, which are climate sensitive, they have said their scenarios that they use for these calculations are consistent with 2.5 and 3 degrees. Something that we expect investors to pay a bit more attention to is BHP's metallurgical coal assets. So in 2020, BHP said that under a 1.5 degree, under their own 1.5 degree scenario, metallurgical coal would be higher than their reference case. We think that's probably a bit optimistic, and maybe and is likely part of the reasoning that they've used to conclude that they wouldn't have an impairment. We think that assumption around demand is questionable, but just to be really, really clear, we're not asking them to change that assumption. We're asking them to disclose what those assumptions are and how that impacts on pricing, and to more clearly articulate how that flows through to their sensitivity calculations, such as on impairments. As we'd all be aware, and Harriet mentioned earlier on, BHP has not supported our resolution. So despite being well ahead of where Origin Energy was, they've said that they will not support our resolution for a range of reasons. So in the notice of meeting that was issued a couple of weeks ago, the BHP board said they don't support the resolution. In our view, the reasons they gave are inconsistent, and they actually just willfully misrepresent our resolution. So we've categorised what they've said into a number of reasons. The first one is that it would breach accounting standards, since it may require a positive remeasurement. So there's nothing in our resolution which says that we're asking for a positive remeasurement. We're asking for a sensitivity analysis and the results to be quantitatively disclosed. If the asset value would be higher than the book value, then that would result in a zero sensitivity. And disclosing a zero value for a sensitivity analysis for an impairment is common practice and satisfies both the resolution and the accounting standards. They've also said that a 1.5 scenario is speculative, and as such should not be disclosed in their financial statements. We find that particularly odd because they've discussed a 1.5 degree scenario in the last 2 years' financial statements. So if it's inappropriate to be including it, firstly, we disagree that it's inappropriate to include a low carbon climate sensitivity. But if you did take that as a given, then we would seriously question why BHP think it's a reason not to include it when they've actually already included the substance or elements of the substance of the resolution in recent financial statements. They've also said that a 1.5 degree outcome is not BHP's best estimate of the future. We're not asking for them to change their best estimate. We're simply asking for a sensitivity. We think this is a willful misrepresentation of what we're asking for. BHP has said that climate change is covered in other publications. As Sue's pointed out, climate change is a financial risk. It's an investment risk that belongs in financial statements. It's the job of the financial statements to articulate a true and fair value of a company. And BHP has acknowledged that their value, that climate is a financial risk, and therefore we think it belongs in the financial statements. BHP also said they support non-financial climate reporting standards. So there is a broad body of work being led by IFRS to create a series of sustainability standards. These are likely to be a step change improvement in disclosure of sustainability risks and issues including climate change, but they're not a replacement for covering climate change in financial statements. The draft IFRS standard and the draft AASB standard modelled off that draft IFRS standard both say that those documents are intended to support rather than supplant disclosures in financial statements. So it's definitely not an either or. We welcome BHP's disclosure of climate change outside of financial statements, but that is not a justification to exclude climate change from their financial statement. So in conclusion, climate risk is financial risk. It definitely belongs in financial statements. As Sue very clearly articulated, both regulators and investors expect this. This is not a radical ask. This is a compliance request. Disclosure of climate risk in financial statements, including low carbon scenarios, needs to become standard across the ASX for companies which are exposed to climate risk. BHP appears to understand the issues. They've been talking about a 1.5 degree sensitivity in their financial statements for several years. What we're asking for them is to adequately disclose their assumptions. And to be perfectly frank, we think BHP's reasons to vote against the resolution are not coherent. That we think they're inconsistent and willfully misrepresenting what we're asking for. That's the end of my slides. I think I'll pass to Harriet now, and then we'll have questions after that.
Thanks, Alex. Thanks, Sue. Yeah, a bit of a change in tempo and focus now. So moving to our second resolution, which, as I mentioned earlier, ACCR's focus on BHP's lobbying activities has really, to date, focused on the membership of industry associations and constraining the negative influence of those associations. This resolution is novel and takes a different tact and really turns attention to BHP and the role BHP is playing in the policy debate in Australia. And so what we're asking the company to do is to proactively advocate for Australian policy settings that are consistent with the Paris Agreement's objective of limiting warming to 1.5 degrees. And I just emphasise as well the text in the resolution, which states that nothing in this resolution should be read as limiting the board's discretion. I highlight that because one of the reasons BHP has recommended against this proposal is because it states that it is seeking to limit the board's discretion. So why did we file this resolution? The fossil fuel lobby, I think most of you would be aware, is a major barrier to decarbonisation. The IPCC in their Working Group 3 report this year recognised that more so than it has in previous reports, with a specific chapter on political economy where it called out the impact and effect of fossil fuel lobby campaigns against climate change policy, particularly in the US and Australia, where they're quite famous for being so effective. So, you know, the losers from decarbonisation have just been too influential for too long on our policy. And what we really need to see is the winners from a fast transition stepping up. Australia is a long time laggard in climate policy, but the recent change of government really gives it an opportunity to accelerate the decarbonisation of this economy. But the fossil fuel lobby does remain the biggest impediment to our transition. And here are just a few snapshots of media releases from different industry associations around key policy proposals in recent times. The good news for BHP's shareholders is that BHP actually is a winner from rapid decarbonisation. It has been saying since 2020 that a 1.5 degree scenario is best for business. So this is a chart taken from the 2020 climate report. You can see that green line is the 1.5 scenario, demonstrating the relative value over time to shareholders under that scenario, and quite clearly that that's delivering the greatest value. In addition, BHP has significant potential to exert climate positive policy influence in this country. It is our largest company. It is one of the most politically powerful listed on the ASX. It also has a very strong track record of getting what it wants when it comes to policy in this country. We saw that with its activities around the mining super profit tax. It was quite active in the repeal of the carbon price. And we've seen it more recently flexing its muscles around the Queensland government's increase in coal royalty rates as well. And we've got a series of headlines, highlighting that on the next slide. As stated, BHP has proven it can get what it wants on policy when it wants. And there are some really immediate opportunities for BHP to proactively advocate on climate policy. These might relate to pushing for the rapid renewable energy rollout and electrification policies. There's a really strong relationship there with demand for its commodities, pushing for best practice methane measurement and management policies. There's also scope for, these are all just examples, right? But, you know, scope for BHP to engage in a constructive way around the conversation around the fuel tax rebate, which could sort of mid-decade or so be restructured so that it's used to incentivise the shift away from diesel in mine operations and mine haulage and moving to electrification, rather than potentially, or actually acting as a barrier to that shift. BHP stated in the notice of meeting that its submission on the safeguard mechanism is a good example of how it actually is advocating in line with 1.5 degrees. We would argue that that's not quite the case. We'd say its approach is quite mixed at the moment. It was good to see in that submission that it supported the removal of overly generous baselines or headroom. However, it did also push for the linkage with international offset markets, which risks the safeguard mechanism being flooded with cheap credits and undermining any sort of incentive for industrial emitters to actually decrease their emissions. And this is at odds with BHP's own stated commitment to the mitigation hierarchy. Another point that stood out for us in that submission was BHP pushing back against any suggestion of best practice emissions performance requirements being placed on new facilities, stating that most new investment in the next 5 to 10 years will be determined by technical and financial studies carried out in the previous 5 to 10 years. We think that that's a bit of a sort of slow approach to embracing best practice, and we in fact would expect BHP to be telling government and its shareholders that it is prioritising best practice emissions performance in the design of its new facilities. So like the accounts and audit resolution, BHP has recommended against this proposal as well. It's articulated a series of reasons. The first being that it states it already advocates in line with the Paris Agreement's objective of limiting warming to 1.5. Our response to that is that if that is the company's view, then it could easily have supported this resolution. As stated before, it says that the resolution is interfering with the board's discretion. The text specifically states it should not be read as limiting the board's discretion. So we challenge that point. The company also says that the resolution is too broad and ambiguous. Investors would appreciate that you have to avoid being too prescriptive when you're filing shareholder proposals. That can make it very difficult for investors to support resolutions. This resolution is principles based, but we would argue that it is still directed. And our supporting statement provides further detail on how it can be interpreted and implemented. Another key one that stood out to us was that BHP said the proposal was committing BHP to forward-looking positive actions and creating a greenwashing risk for the company. Firstly, we would say that this is a non-binding advisory resolution. But secondly, BHP states, as a matter of fact, in the notice of meeting, that it is already advocating in line with 1.5 degrees. So we would argue that, if there is in fact a risk, a disconnect between what it's saying and what it's doing, that risk already exists. And finally, BHP states that it's better able to support climate policy by meeting its own targets and making the case for the economic opportunities arising from the energy transition. On its targets, it's probably not news to investors that BHP's Scope 1 and 2 targets and 3 are not aligned with 1.5 degrees. In fact, we think that a better suite of climate policy in Australia and the other jurisdictions it operates in could enable BHP to enhance the ambition in those targets. So there's a complementarity here. And of course, we encourage BHP to be advocating more fulsomely for the energy transition and to be pushing for scientifically credible decarbonisation pathways for Australian industry. So to conclude, ambitious climate policy is best for BHP shareholders. BHP itself sees major opportunity for its commodities from rapid decarbonisation. However, positive change has just been encumbered by the fossil fuel lobby for too long, and BHP can really help to change this, as can other diversified miners, the likes of Rio Tinto. BHP is one of the most politically powerful companies in Australia, and we would argue that if BHP purely restricts its focus on policy being the constraining of its industry associations, that is not enough. At this key point in time, we need to see BHP itself stepping up. Additionally, the rapid decarbonisation in Australia can have global consequences. It can really show other jurisdictions how this can be done in a fossil-heavy economy. And whilst BHP and others may view that a 1.5 degree pathway is less probable, that's not a reason to be pushing for not push for the most ambitious policy that we can get. Policies that still seek to shift companies towards 1.5 pathway is good for BHP's business, regardless of whether that pathway will be ultimately achieved or not. That is it from me. So I think back to you, Gemma, for some Q&A.
Thanks, everyone. Great presentations. I will just remind everyone that if you do want to ask a question, please pop the question in the Q&A box at the bottom of the screen. Sue will be with us for another sort of 10 minutes. So if you do have a question specifically for her, this is a great opportunity to ask. So look, we'll just go to the first one that has come in. So Sue, this is going to be one for you, I think. If it's an existing current requirement to include climate change in financial statements, why aren't more companies doing it properly already?
I think in a way that's a bit of a difficult one to answer, and a bit of a mystery to ourselves as well. I think, you know, in one respect, things have sort of snuck up on companies, and I'll have to say, you know, the volume of sort of the new risk assessments that we're seeing on climate, the target setting is increasing, you know, by orders of magnitude as well, and it's simply that hasn't yet translated, or they haven't quite caught up in kind of rippling that through into the financial statements themselves. I mean, I could also suggest that there's areas of disclosure that we're talking about that are principle based. We have principle based accounting standards and disclosures, and it's maybe a real test of those more general. You know, is this understandable? Does this make sense? Have I explained enough of, you know, why I don't have an impairment adjustment, and is it because I've assumed prices of very high prices that may not be sustainable actually, and very high volumes that may not be sustainable. I mean, it's a number of things, and I think we see in audit reports too, the auditors are not pushing it as they should. So I think there's a whole lot of catching up. But what I would say is that we've got, you know, enhanced risk assessment, enhanced, you know, government action, enhanced action that companies themselves are taking. So the environment is ripe for coming to grips with that enhanced materiality and getting on with the disclosure that's needed.
Excellent, thanks. Alex, have you got anything to add to that one, or?
I definitely defer to Sue's expertise on the accounting nuances. But one of the things that I wonder is is because it feels like this overwhelming wall of expectation. And I think once that norm is set and a few decent precedents are out there, I think it could very quickly become normalised. And that's what we'd like to see, you know, in our case across the ASX. But I don't see why there's a genuine barrier to doing this globally for all listed companies.
Sure.
Yeah, I would say that we are definitely seeing, even though the scores are up slightly year on year, underneath that, and I didn't cover this point on it, but it's on the slide, there has been advancement and more assumptions, for example, being disclosed. And as I said, 3 companies doing these sort of scenario analyses. So it is beginning to happen, and others can then have a look at the better examples that are emerging.
Okay, next question. If it's a regulatory expectation, do you imagine that we'll see legal cases against companies or their auditors for not robustly addressing climate change in the financial statement? So is this an emerging risk?
Is that to me as well?
That's probably a good one for you too, if that's all right.
Yeah, I mean, I guess, you know, there's almost a hard way and an easy way of doing this, right? I think the easy way is sort of, you know, having a go and starting to disclose the better information. I think if there ultimately is a failure to do so and large impairments result later in the day, more investment is made, there is financial harm. I'm not a lawyer, but I would suggest that that is a increasing risk the longer it goes on. That investors don't have the information that the market, sort of the market system, because it's in the requirements already, expects it to be getting. Yeah.
Excellent, thanks. And look, I've just had another one come in the Q&A. Is it a case of the forward-looking element, for instance, impairment, just being too difficult? One, because a company's view of future warming scenarios will be at odds with auditors and regulators. And 2, investors have an unrealistic view of the accuracy of those figures. Can you shed any light on that one, Sue?
Yeah, I think accounts should always be taken to include lots of judgments, estimates. It's not hard numbers. It really isn't. And that's why assumptions and estimates where made and where material should be disclosed, so that context can be understood. And I guess it almost goes back to the sort of legal question as well. At what point does it become the risky thing to do not to provide an updated estimate, if you will? So at what point does providing no estimate and assuming things are business as usual, that becomes riskier than at least providing something of an estimate, being clear on the assumptions and say the extent to which targets have been included in the accounts, and therefore the extent to which they have not. You know, I think, you know, this isn't going to cost us anything is not a better estimate than I think it's going to cost X amount per year to undertake the activities we need to with our supplier base or our whatever it is. You know, that becomes a better estimate at some stage. And I think for some, they really need to think about what is their best estimate, and it is just a best estimate.
Yeah, I agreed. Thank you for that, Sue. Okay, we do have one on lobbying for you, I think, Harriet. It appears the ACCR is condoning aggressive lobbying by corporations in your resolution. Isn't that bad for our democracy?
Thanks, Gemma. Do understand the question, but I think we have to operate within the reality that we're in. And the fact is that the fossil fuel lobby has a significant influence on our policy development process, and we really do need to see those alternative corporate voices and powers coming up and resisting that influence. I would argue that, yes, it is not great to have unchecked corporate influence on policy, but it is what is happening. And also, unchecked climate change is also a major threat to democracy. So we would argue that the ask is worth it.
Great points. I guess this one just follows on from that as well. I mean, I guess the view is that climate change wars are over. And do you really think we could see a repeat of the campaign against the carbon tax? Will history repeat?
I always say I've got a bit of trauma from that campaign because I was seconded to, Woodside at that stage, Alex. So it was very, very seared in my memory, the effectiveness of that campaign. I do think that the nature of corporate advocacy has shifted. I don't think the pushback will be quite as blatant as it was during the carbon tax campaigns, but that doesn't mean it's gone away. It is definitely, it's more nuanced, it is more sophisticated, but the motivations for the fossil fuel lobby are still very much present. I don't know if many other people have been trawling through the safeguard submissions like we have been, but definitely a fair bit of pushback on almost every aspect of that policy that could render it being an effective mechanism for constraining the industrial emissions in this country. What we're not seeing, and perhaps I'm sort of repeating myself, is sufficient corporate voices speaking up and creating more of a permission structure for governments to be bold and to be brave and to implement the really ambitious policy that we need to see.
Great points. Thank you. I think we've probably got time for one last question. So, this is, I think, one for you again. Are the requirements to report on climate change in the financial statements equally applicable in all jurisdictions?
I would say yes, and we so kind of touched on the IFRS and Australian GAAP being aligned with that. IFRS is essentially followed in a sort of 120 or 140 countries now. Sometimes there's a bit of a trailing implementation, but most of the requirements that we're talking about, in fact, really all of them, these are old standards. There's not a lot new. And any guidance that says climate is already baked into them is just guidance. It's the standards that form the basis of the requirements, not really the guidance. So the guidance actually tells us it's already there. So yes, I think in other countries that follow IFRS-based accounting standards, perhaps the other one that should be mentioned is of course the US and US GAAP. There are quite similar requirements, and the Financial Accounting Standards Board has indeed produced a document saying as much, that they did it sort of in a slightly wider context, that ESG matters, including climate, are already baked into the accounting standards and they should be applied. But there's lots of forward-looking estimates, very similar to the IFRS approach. Some of the mechanics differ ever so slightly, but the requirements are there. The PCAOB is also looking at enforcing auditing standards that have very similar requirements on risk assessments and reporting of what the auditor assessed as key or critical audit matters in the audit. So that at a level that we're talking, well, yes, very, very similar requirements globally. And the work we've been doing to analyze accounts and Carbon Tracker has been leading on, has been looking at companies in the US as well as those outside.
Excellent. Well, we are very much approaching the end of the hour. So again, I would just like to thank Sue for taking the time to dial in and give her expert opinion today. And Harriet and Alex, thank you again, as always. If you do have any follow-up questions, please reach out to us directly, and we look forward to catching up with you during the next webinar. Thank you very much.